The Beginner's Guide to Investing. How to get started today. Hello and welcome back to Economy Engine. This video actually deals with the topic we've already made a video about, the Beginner's Guide to Investing. This is what you can call a second part. If you haven't watched the first video, we recommend you go back and watch that, and then head right back to this video. If you're new here, be sure to subscribe to the channel and ring that notification bell to get notified of our latest update. So without further ado, let's continue with our topic. Number 5. Investment strategies. Now we come to the strategic part of the video. Let's discuss some of the strategies to kickstart your investing journey. At first, we have the buy and hold strategy. This strategy involves purchasing investments with intention of holding them for an extended period, typically years or even decades. The focus is on long-term growth and weathering short-term market fluctuations. Then we have dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. By consistently investing over time, you can potentially benefit from purchasing more shares when prices are low and fewer shares when prices are high, smoothing out the impact of market volatility. Then comes value investing. Value investing looks for undervalued stocks or assets that they believe are trading below their intrinsic value. They focus on fundamental analysis, such as company financials and market conditions, to identify opportunities. The goal is to buy assets at a discount and potentially profit when the market recognizes their true value. Next up, we have growth investing. Growth investors seek investments with strong growth potential. They focus on companies or sectors that are expected to experience above-average growth rates. These investors prioritize capital appreciation and are willing to accept higher volatility and potential risks associated with growing stocks. Then we have dividend investing. Dividend investors focus on investing in stocks or funds that pay regular dividends. The goal is to generate a steady income stream for these dividend payments. Dividend investors often target stable companies with a history of consistent dividend payouts. Next up, we have index fund investing. Index funds are mutual funds or exchange-traded funds, ETFs, that aim to replicate the performance of a specific market index, such as the S&P 500. This strategy provides broad market exposure and is often used by investors who prefer a passive approach and want to diversify their holdings. Then we come across asset allocation. Asset allocation involves diversifying your investments across different asset classes, such as stocks, bonds, real estate, and cash. The goal is to create a portfolio that balances risk and potential returns based on your risk tolerance and investment goals. Rebalancing the portfolio periodically helps maintain the desired asset allocation. And lastly, we have tactical asset allocation. Tactical asset allocation involves making adjustments to your investment mix based on short-term market conditions. Investors employing this strategy aim to take advantage of perceived opportunities in different asset classes, adjusting their allocation accordingly. Number 6. Importance of financial goals. Financial goals play a vital role in shaping our financial decisions and behaviors. Financial goals provide a sense of direction and purpose in our financial lives. They help us establish clear targets and guide our financial decisions. Without goals, we may wander aimlessly, making haphazard financial choices that do not align with our long-term aspirations. Setting financial goals can be highly motivating. They give us something to strive for and help maintain our discipline when it comes to managing our finances. Goals provide tangible representation of what we are working towards, serving as a constant reminder of why we need to make sound financial choices and practice good financial habits. Financial goals help us prioritize our spending, saving, and investment decisions. They serve as a framework for decision-making, allowing us to evaluate whether a particular expense or investment aligns with our goals. This helps us make informed choices and allocate our resources wisely, focusing on what truly matters to us in the long run. Clear financial goals provide benchmarks against which we can measure our progress. They enable us to track our financial journey and evaluate whether we are on track to achieve our desired outcomes. Regularly monitoring our progress against our goals helps us stay accountable and make necessary adjustments along the way. Financial goals are instrumental in securing our long-term financial well-being. By setting goals related to retirement savings, emergency funds, debt reduction, and other financial milestones, we ensure that we are actively working towards building a solid financial foundation. The long-term focus helps us to avoid short-sighted decisions that may hinder our financial security. Financial goals provide a framework for adapting to life's changing circumstances. As our personal and financial situations evolve, our goals may need to be adjusted. By regularly reassessing and refining our goals, we can ensure they remain relevant and adaptable to changing needs, whether it's starting a family, changing careers, or facing unexpected financial challenges. Having clear financial goals brings peace of mind. It provides a sense of control over our financial future and reduces financial stress. Knowing that we are actively working towards achieving our goals can alleviate anxiety and help us navigate financial uncertainties with more confidence. In summary, financial goals are essential to creating a roadmap to our desired financial future. They give us focus, motivation, and direction in our financial decision-making, enabling us to make sound choices that align with our aspirations. By setting clear financial goals, we enhance our financial well-being and increase the likelihood of achieving long-term financial security and success. Number 7. Common mistakes to avoid. While investing can be a rewarding endeavor, it's important to be aware of common mistakes that can negatively impact your investment outcomes. Let's talk about some common mistakes to avoid. Investing without proper research and understanding of the investment options is a common mistake. It's important to thoroughly research and educate yourself about the investments you plan to make, understanding the risks involved, the historical performance, and the underlying fundamentals of the investment. Allowing emotions to drive investment decisions can be detrimental. Making impulsive decisions based on fear, greed, or short-term market fluctuations often leads to poor outcomes. It's crucial to stay disciplined and make rational decisions based on careful analysis and long-term goals. Failing to diversify your investment portfolio is another common mistake. Concentrating your investments in a single asset class, sector, or individual stock can expose you to undue risk. Diversification across different asset classes, geographies, and investment types can help reduce risk and increase the potential for consistent returns. Trying to time the market by predicting short-term price movements is challenging and often leads to poor results. Attempting to buy at the lowest point or sell at the highest point is a speculative approach that even experienced investors struggle with. Instead, focus on long-term investing strategies that align with your goals. Failing to assess and manage investment risk is a significant mistake. Understand the risks associated with each investment and determine if they align with your risk tolerance. Consider factors such as market risk, credit risk, liquidity risk, and inflation risk. Regularly review and adjust your portfolio to ensure it remains in line with your risk tolerance and goals. Investing based solely on past performance can be misleading. Investments that have performed well in the past may not necessarily continue to do so in the future. Instead, focus on the fundamentals and long-term potential of the investment, rather than chasing short-term performance. Frequent trading portfolio turnover can result in higher costs and lower returns. Transaction fees, commissions, and taxes can eat into your investment returns. Strive for a balanced approach and avoid unnecessary trading unless it aligns with your long-term investment strategy. Failing to periodically rebalance your portfolio can lead to an imbalance in asset allocation. Over time, some investments may outperform while others underperform, causing your portfolio to deviate from original asset allocation. Regularly review and rebalance your portfolio to ensure it aligns with your desired risk profile. Delaying investing and not taking advantage of the power of compounding can be a significant mistake. Starting early and consistently investing over time allows your returns to compound, potentially generating significant wealth over the long term. Time in the market is often more important than trying to time the market. Some investors may avoid seeking professional guidance, which can lead to suboptimal investment decisions. Financial advisors can provide valuable insights, personalized advice, and help create a comprehensive investment plan tailored to your specific goals and circumstances. By being aware of these common mistakes and taking proactive steps to avoid them, you can enhance your investment experience and improve your chances of achieving long-term financial success. I hope this beginner's guide to investing has ignited your passion for creating wealth and achieving your dreams. Don't forget to hit that like button, share this video with fellow aspiring investors, and subscribe to our channel for more valuable insights. Remember, together we'll conquer the world of investing.